I think the reason why you're still kind of level-headed, and I think I am, but we get a little nervous like everybody else. I think the main reason is that we know stock market history. We know that the market goes through normal cycles. Of course, a lot of people are saying that this is different because, of the political risk, which I learned about in my CFP classes. That's another risk that exists where policy and politics can pose some risk. But regardless of, why, we know that we've been through all kinds of situations. COVID, nobody predicted that. And of course, that was so different than anything else. But here we are today. So, of course, we always see the headline when the market's down. Oh, you shouldn't worry about it. You'll be fine. And I'm not saying that's not true, but I feel like we should say, stop telling people not to worry. It is natural and normal for people to worry, to be fearful. I mean, in the moment, like right now, it is frightening. And that's okay. Acknowledge the moment. Now, people will worry and feel scared just like we are, but we put together a few things that you can do with that fear.
This week has been a little rocky. Next week might be rockier still. We'll still be here recording Catching Up to 5. We'll try and bring you sort of more actual contemporary podcasts at times on Wednesdays when things like this do happen. It's a fun discussion. I want to close probably with reading a quote from Jesse Kramer, one of our prior guests, because he took a bunch of calls today as a financial advisor from his clients about, okay, I want to do this. And he's like, well, let's not do that. And let me tell you why. But what he wrote today in our community, I think, is appropriate. Just wrote these words to concerned investor this morning. We don't let fear, panic, or other negative emotions guide our investing decisions. We also don't let greed or exuberance guide our decisions. Good investing is inherently a non-emotional practice. It's not easy, though. If it was, everyone we know would already be doing it. Times like these, especially, are when our mettle is tested. This is when the millionaires are made, when you can stay the course here and keep dumping cash on the fire. Welcome to Catching Up to 5, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to 5 together.
A Guided Meditation for When the Stock Market is Dropping by J.L. Collins. Welcome to this guided meditation for your journey to financial freedom. Let's begin. Find a comfortable place to sit. Breathe in and out. In and out. Settle into your space. Now, slowly close your eyes, or perhaps hold them half open and unfocused. Breathe in and out. In and out. Focus on the sound of my voice. Breathe in and out, in and out.
Hello, and welcome back to Catching Up to 5. It's Friday, April 4th. Oh my goodness, what a week we've had this week, Jackie.
Oh, Lord, we survived. Bill, I had to break out the wine. Are you kidding me?
What, are you celebrating?
Oh, Lord. I'm celebrating this week being over. Are you kidding me?
Is it over? That's the question, right?
Well, this week is. We need this. This is Friday, April the 4th, like you mentioned. So I need a pause. I'm going to enjoy these next 2 days where the market is not open.
Yeah, we didn't trip any circuit breakers, but it looks like we came close.
Ooh. Yeah, so let me get a glass of my wine before we have this conversation.
We haven't had a week like this since 2020 or something close to that.
Yeah, that was, I believe, from January 2020 to April 2020 was the COVID scare, and we had a big drop. And probably prior to that, Bill, 2008, that was pretty awful because honestly, I remember 2008, and that's when I started most of my investing. But what was different was that there were multiple markets going down: the real estate market, the stock market, like the bond market. Every single market went down. Right now, it's pretty much the stock market. So far, the real estate market is still pretty strong. So we made it. We made it out of this week. We'll have to see what next week's brings. But we had a
Well, I
rough
was a
week.
little distracted because you were visiting me at home.
Yay!
And we were having lunch together again.
At a cool Thai restaurant. What was the name of that restaurant? Let's give them a shout out.
Tuk Tuk.
Tuk Tuk. I thought it was a cute name. It was right off of the interstate. So I visited my sister for her birthday. Happy birthday, Gwen. We celebrated in Atlanta I told you about this really cool place called the Red Phone Booth.
Okay, yeah, that's right. It's a cigar bar. You give my wife a cigar to celebrate.
Yes.
Getting through a healthcare journey that we've been on over the last year.
Yeah, she deserved it. But yeah, on my way back, you're like, well, if the time works out, stop by, and we got a great Thai place that's right off the interstate. So I'm like, why not? I got to have lunch somewhere.
Well, what's interesting is, if we hadn't looked at the market, life wouldn't have changed. Here we are having lunch, but you and I being finance, geeks,
Right.
we may have taken a peek and we're like, oh my goodness, the tip just got more expensive. Or something like that. But the world didn't change. It didn't fall apart. Finances were falling. There was red in the streets, but I don't feel any different today than I did at the beginning of the week, quite honestly.
Yeah, it was a pretty exciting week, probably more to the bad for most people. But yeah, so I think the reason why you're still kind of level-headed, and I think I am, but we get a little nervous like everybody else. I think the main reason is that we know stock market history. We know that the market goes through normal cycles. Of course, a lot of people are saying that this is different because, of the political risk, which I learned about in my CFP classes. That's another risk that exists where policy and politics can pose some risk. But regardless of, why, we know that we've been through all kinds of situations. COVID, nobody predicted that. And of course, that was so different than anything else. But here we are today.
Yeah, I mean, tariffs are just one thing. We were due for a correction. Hell, we've probably been due for another bear market. It's been 5 years. We're overdue. So some of this is very predictable because a correction happens once a year, right? Something like that. And we haven't had a correction in a couple of years. And a correction, just to define it, is a 10% drop from peak to trough. And so we can define it for other folks. A bear market is a 20% drop from peak to trough. And we're not quite in the bear market. And the total US NASDAQ is 22% down from February 19th, which was our most recent peak. But we're close. And it could come on next week. We don't know what's going to happen. We can't predict nothing. My crystal ball is totally cloudy.
Right. Mine is cloudy. So anyone that with confidence is saying it's going to last this long, it's not going to happen anytime. So, those are opinions that everybody has. The right answer is we don't know. And there's certain things that we don't have control over. So you can either focus on the things that you don't have control over and be very, very frustrated, or you could say, you know what things do we have control over? Does knowing historically how the stock market performs matter? And does it help? So that's what our goal is today. We went through a rough time this week. This is the first week of April. And the reason why everyone's talking about it is because of the rapid drop in the stock market. And what is it, Bill? 2 days in a row, Thursday and Friday, we were down more than 5%.
Yeah, let's go over the numbers here. So the S&P 500 was down 6% on Friday. It's down 7% for the week, 14% year to date, and then down 1% for the year. That is the last 12 months. So we've lost an entire year of gains that are wiped out, right?
Yeah, as of Friday, April the 4th. And I think we'll all be remembering this day. It'll go down in history, right? So those are the interesting numbers. And many of you may be familiar with the most common indexes, but, let's just mention them. So typically, if you're listening to CNBC or something like that, they talk about the Dow. The Dow is the 30 really big companies that's been around for a long time. Okay. I generally don't like to use that one, Bill, because it's only 30 companies. I usually like to reference the S&P 500, which is the 500 largest U.S. companies. So when you just mentioned down on 6% on Friday and so forth, that was the S&P 500. And the other common one that you mentioned was the NASDAQ. So what does the NASDAQ represent, Bill?
Oh, that's the 2,000 largest companies on that exchange, and it's tech heavy, which is why it's down more.
Yeah,
That's the
tech
only thing
heavy.
you really need to know is it's going to have the Magnificent Seven in there, and when tech falls, that falls greater.
Yeah, yeah. So when we mention those are just the most commonly referenced indexes. Okay, so for my numbers and my little portfolio, so I've been retired for 6 years, so that's important because you made a great post in our Facebook group today, and we'll mention some of the feedback that you got in our Facebook group. And if you are not a part of our Facebook group, just go to Catching Up to Fi on Facebook. It's very active, and we had a very good, productive exchange on that post. So thank you for posting that. But here's what my numbers look like, Bill. I'm pretty transparent, so I'll just use myself as an example, right? So my portfolio at the beginning of the year was roughly $1.8 million. Those are my investable assets. I've lost 20% since the beginning of the year. So roughly that's about $360,000. Ouch, right? That hurts. But I haven't lost anything because I haven't sold anything, right? So I've been retired, like I said, for 6 years, and most of my investable assets are in a growth index fund. I've talked about it before, but then I do have an individual stock portfolio, but I always like to stress that probably most people don't need to be having an individual stock portfolio. That's just something I enjoy doing. I analyze great companies, but that is a part of my situation. So if I had to break it up, I would say 80% is in the growth stock index fund. About 15% is in my individual stock portfolio, and the other 5% is in cash. Because again, I'm retired, so I need to have money to live on. So I can't be too risky. Okay. So my growth fund has been down a bit more than that VTSAX, the total stock market fund, or the S&P 500. So let me give you some other numbers that I have. So, okay. So my year to date, the S&P 500 year to date is down 14%. Year to date, my investable assets is down 8%. And over the past year, the S&P 500 was down 1%. We just knocked out all the gains, but my investable assets altogether was up about 7%. So fine, happy with that. But again, I've got VUG, and then I've got my individual stock portfolio. So, but that's just one example. That's how my numbers shake out. What does yours look like, Bill?
Well, I'm in a 75-25 portfolio, roughly 20% bonds, 5% cash, and 75% equities, divided into an 80-20 between U.S. and international. And I'm down 7% year to date, and I'm up over about 8% over the last year. So a little bit better than you because I'm more conservative, but not as much as I might have thought. But we just ran those numbers, and it is what it is. If you look at, depending on your portfolio and these percentages, it could be hundreds of thousands of dollars that disappear. But if you don't sell, you still have the same number of shares, and you're able to buy shares at a discount now. So, yahoo!
Yeah, exactly. So I knew that yours would be doing a little bit better because you are a little bit more conservative, plus international has been doing well. So that's helped you too, right? Mm-hmm. And then you have bonds. So obviously they are not going to be down quite as much as stocks. So for my single stock portfolio though, just back to that, people are always interested, what are you invested in? And how they're doing. Well, I can tell you most of my individual stock portfolio, my individual stocks, most of them are red. Most of them are down over the last week. Some of them down year to date. But however, there's a glimmer of hope here, Bill. There's a glimmer of hope. And I did have 4 stocks that are up year to date. You kind of know what my portfolio is. Oh, you know what? We share a stock that is up year to date, and that is Berkshire Hathaway.
Yeah, we do. We share that one. That's my only individual stock, but it functions as a mutual fund, so I don't really count it.
Right, and that is my largest holding. So that year to date is up 9%. And let's see. Then McDonald's. I have McDonald's. That's up 5%. Kroger is up 11%. And then Northrop Grumman, which is a defense company, is up 5%. So I got some little glimmer of hope there. But again, I don't think that everyone needs an individual stock portfolio unless you have the inclination and the interest like I do. But it was kind of nice to see a little bit of ray of sunshine and all this cloudiness and all the red. So.
Yeah, I mean, people are talking about this. We had over 140 comments in that little post that I made. You know, it's certainly on people's top of mind. It's been a while since we've been here. We need to remind everybody to acknowledge your emotions first, right? Because you're going to have them, but you can't necessarily act on those emotions.
Yeah. So, of course, we always see the headline when the market's down. Oh, you shouldn't worry about it. You'll be fine. And I'm not saying that's not true, but I feel like we should say, stop telling people not to worry. It is natural and normal for people to worry, to be fearful. I mean, in the moment, like right now, it is frightening. And that's okay. Acknowledge the moment. Now, people will worry and feel scared just like we are, but we put together a few things that you can do with that fear, right? To try to turn it around. So one of the things I mentioned was like in 2008, I was investing and I remember how bad it was. And a lot of you that are listening, you lived through 2008. Well, I feel like it was almost 5 times worse in 2008. And one of the things that I did mentally I bottled up how I felt in 2008. Because when I think about after 2008, what happened, it was pretty darn good. And I think that's part of why I was even able to retire early, that helped grow my assets. And so if you can bottle up how you feel today and remember the next correction and what happens after that correction or after that market drop, it could serve you well going forward.
Yeah, I mean, the first thing you got to do, just like being a late starter, is pause.
Right.
Take a pause and then plan. Well, you got to have an investor policy statement, right? That tells you what you're going to do in these times of stress. So you don't have to wonder. You don't have to make it up as you're going along. Hopefully, you have something written down on one page of when the market crashes, because it's going to, and it crashes 30%. We're close to 20%. So we're edging towards the bear market. What am I going to do at 10, 20, 30%? Am I going to rebalance? Am I going to do some other of these things that we're going to talk about today? So the plan needs to be made before the events happen, is what I would say. And don't let your emotions run away from you. If that does happen and you don't have a plan, it's time to pause and put one together. And if you're going to do anything, don't do anything. Just stand there.
Yeah. And Bill, I'm curious. So with your investor policy statement, are you following what you put in that statement right now?
Yeah. Assuming we cross the 20% threshold into a bear market, I'm rebalancing. I'm taking out of bonds and putting into stocks just to, buy at what it may not be the bottom. Who knows where the bottom's going to be? We're cloudy, but at 20%, I rebalance. And if it goes to 30%, I'll rebalance again.
Okay, so we actually did have a question about rebalancing. So we'll get to that toward the end, but you can explain what rebalancing is so that everybody knows what that actually means on the execution side. So, I do have a bias along the lines of health savings accounts. So I hear all the time that people say, oh, I didn't even know I could invest in my HSA. I've got $20,000 sitting in there. So honestly, now's a pretty good time to deploy that. But if your HSA is set up where you want it for a long-term vehicle and you want to use it in retirement where it makes sense to invest it, now would not be a bad time. And I started investing in mine in 2008, and that's why it has grown so much to where it's over $200,000. Even with the market drop and everything this week, it's still over $200,000 in my HSA. So go check your old HSAs. If you got any old HSA that's just sitting there and you want to use it for long term and you think you want to invest it, now would be a great time.
Yeah, I mean, it's a good time to talk about rebalancing too, because every aspect of your portfolio has sort of a risk profile. And for me, an HSA is a high risk profile. It's all 100% equity index fund. I pick one of them. And actually, in my case, it's an 80-20 of my equity between US and international, but it's 100% equities. And the same is true in my Roth IRA. But across all the individual funds that I have, whether it be a Roth 401k or IRA, each of them has their own kind of risk portfolio. But across the entire portfolio, it's a 75-25. And while you can have an individual risk allotment in your HSA or your Roth IRA, across the portfolio is where you rebalance. And rebalancing is often bonds to stocks. It's a good idea to hold bonds in your tax efficient pre-tax portfolio so that it's easy to rebalance without any tax consequences. It's harder to do in an after-tax brokerage account, for example. You can do it, but you're going to see capital gains. It's easier to rebalance within your tax protected accounts. That's a general look at rebalancing. Does that help, Jackie?
Yeah, because one of our community members was like, I'm not sure what rebalancing actually looks like. So you gave a good explanation, but I think also a really good scenario is like in your 401k or your employer sponsored plan, whether it's a thrift savings plan, 401k, 403b. And actually, we had a very smart community member that replied to the comment and I thought did a great job. But basically, if you're doing it in your 401k or something like that, and your goal is to be 80% stocks, 20% bonds, well, if stocks are sucking really bad like they are now, well, now your bonds may represent 30% and your stock is 70%. So how do you get that in balance? So rebalancing says that you would go in and say, let me make sure, or let me get this back to the allocation that I want. I need it back to the 80% stocks, the 20% bonds. Some people will, how frequent would someone do something like this, Bill?
People stick to a calendar rule where they'll do it once a year. And I have that, but then I also have some guidelines outside of that when there are big swings in the market. I mean, it's always good once a year, once every 2 years, but then there are times where it's an opportunity.
Right, like now.
Yeah, and you got to take that opportunity.
Yeah, so that's what rebalancing is for anyone that wasn't clear on how to do that. A really important concept. Now, my brother Charles, so I've been helping him with his 401k, and he is very nervous right now. And I know a lot of people are very, very nervous with what's going on. They look at their 401k and they're like, why am I seeing all this red? I don't know if I should be doing this. Well, I will start high level with the golden rule of investing. And that is buy low. Right now, we're really low, and sell high. So if you're still making contributions to your 401k and you're still working, that's really a good thing because you are getting more shares and more money in while the market is down, while the market is low. It's really hard to mentally do it sometimes when you see the market going down, but you are benefiting from that if you are making contributions. So stay the course with making your contributions to your 401k and your retirement account, because in every period in history, the market has always come back. That you can count on.
Yeah, I mean, you go through the numbers too. Over the last 20 years, the market's only been down 3 out of those 20 years.
Yeah.
And over the last 60 years, because that's my age, the market's been down only about 22% of the time, or up 78% of the time. The general rule of thumb is 3 out of every 4 years, you're going to see the market go up. And we don't know where this market's going to end up this year.
Right. We have no idea.
We have no idea where we're going to be at the end of the year. It can feel all doom and gloom, but
that's
years don't always turn out that way. The down years turn into up years. So who knows?
Right. And we never know from year to year. So one of our data points, not the only data point, but one of our data points is how has the stock market performed in the past or historically? But like you said, the stock market is up way more years than it's down. So if you start to, I guess, manage your portfolio or think in terms of, oh, what if the market goes down? Well, it will go down. It's supposed to go down. That's a normal cycle. However, know that the market is up way more years than it's down. Like you said, for the last 20 years, it's been down only 3 years. But if you go back further, the average is, like you said, 3 out of 4 times the stock market is up versus down. That's pretty powerful. And it's a good data point that could be helpful to you as you are mentally trying to get it through your head that, hey, okay, this is starting to make sense. At least looking at historically what's happened, I can roughly expect, this to happen in the future.
And one more word to rebalancing. This was asked in our community as well. I forget by who, but you can forward rebalance. The assets that have taken the most hit are the ones you should probably be buying in order to build up that number of shares again. So you can buy the assets that are most, like for example, international stocks are not hit as hard. So you may be wanting to buy US stocks now because they're down more, and you can rebalance by putting your new money into those equities as opposed to putting money into the less depressed, say, international equities. Does that make sense?
Yeah, it does make sense. And thank you for giving an example. I always do better with like specific examples. So that makes sense. Now, let's not forget about the wise words of our friend Warren Buffett. This quote has been shared 1 million times at least. And this famous quote is, be fearful when others are greedy and be greedy when others are fearful. And I remember, I don't know if this was part of the same quote, but he says, when the market's on sale, meaning the stocks are down, the market's down, run out with wash tubs, not thimbles.
That's a good one. I have another one for you too.
Yeah.
When the tide goes out, we know who's not wearing swimming shorts.
That's right. That's right. Oh, and you know when that quote was used a lot in 2008, because you had, I guess you can call it the Big Short with real estate, where it had those bad subprime loans and they were packaging them up. That was used a lot. But Warren Buffett, obviously a very wise man, probably one of the most successful and widely known investors ever. So I love a good Warren Buffett quote. And actually, you're a shareholder too, but I just got the annual shareholder packet in the mail today with his annual shareholders letter. And I always love to read that. And I'm not even a big reader, but I'll read anything Warren Buffett writes.
Well, if he puts out a podcast, I'm sure you've listened to it.
Oh, for sure. For sure. Now,
what do you think about those market timers out there? There are some people that said, you know what, January 20th, I'm going to cash. And, I don't know what's coming, but a storm's coming. And they're feeling pretty smart right now, I imagine. But what's the problem with that?
Yeah, I've had coworkers that have done that. And, maybe they're smarter than me, but you got to be right 2 times. You got to know when to get out and when to know when to get back in. And you got to really kind of be watching it to figure out what that entry and exit point is. Now, to me, that's a lot of work without guaranteeing or knowing, how it's going to work out. But there's always some people that do that. And I don't know if they're right or wrong. I don't know if they would share if they were wrong. But for that level of market timing, I'm not brave enough to do something like that. But we've had people post in the group. I've had people post in other groups and elsewhere where they're like, yeah, I got it in January. I knew it was the right time. I'm like, I'm so glad you knew. Please let me borrow your crystal ball.
Yeah. And one thing you suggest to people is take a screenshot of your portfolio today or your accounts today and say, where is it? Where is it now? Okay.
Right.
And then let's put it under the mattress for a little while. And let's come back in 6 months, 12 months, a year or two, and see what that screenshot looks like today.
Yeah, if I would have done that in 2008, which I think screenshots were available back then, but in 2008, I probably printed it out. But it was pretty interesting to see how awful everything was in 2008. And then I go back a year later, 2009, great. And you know what? Let me just reference just how the market bounced back. So in 2008, do you know how much we were down in 2008, Bill, that year?
I think it was in the realm of 45, 50%.
Not quite that much. Maybe yours was, but it was down 37. The S&P 500 was down 37% in 2008. Now, the 5 years after that was tremendous. It bounced back like a trampoline. So in 2009, the S&P 500 was up 27%. 2010, it was up 15%. 2011, it was only up 2%. But 2012, it was up 16%. And 2013, it was up 32%. So I don't know at what point the market timers would have gotten back in, but the market was very, very impressive and very strong for another 10 years. There was no significant pullback after 2008 until like around 2022. So the market has had very strong gains. And I usually will tell people part of me being able to retire early, I give a lot of credit to the market. You know, I was mostly invested in stocks, whether index funds or individual companies, and that made a difference.
Yeah, I mean, what do you tell the late starters, though, who may not have necessarily the time to recover? Hopefully, our late starters in their 50s, unless they're working until 65, weren't 100% stocks because they may have been caught with the tide going out and their swim shorts not on because of the greed factor in the market, or feeling the need to take risk. And how is your risk tolerance feeling today versus the beginning of the week?
Well, as we know, that is a big issue. When you got a late start, a lot of times we feel like we need to take more risk. That is a normal reaction. But I think we should normalize the fact that to reach retirement, it's more like 10 to 15 years versus the 40 years that we've all been told. The 40 years is based on companies, employers having pensions that required you to work that long. Now we've talked about it. We've had guests on the show. And if you had, by the time, when you wake up and you start doing things right, normally if you're a late starter, you're not at zero. You've been doing something, even if it's only paying into the Social Security system, you're closer to Social Security. But even in your investments, if you've just been doing the match, that's something. And when you get going, you're going to move way faster than you ever imagined. That's what happened to me. It was not my intention to retire early. I was just catching up after my divorce. And this was around 2004. And it's just crazy every time I think about the fact that it took roughly 12 years for me to move from being financially ignorant to starting to becoming financially literate, to understanding investing and the fact that you have to invest in order to grow your wealth. You cannot save your way to wealth. So just sitting in a savings account wasn't going to do it. And before I knew it, I had run so fast because I was running away from, poverty and thinking that I was never going to be able to retire. I was in my 40s, my mid to late 40s, when I realized, wow, I'm doing these numbers like the fire people tell me to do, 25 times your annual expenses. And I was investing my money mostly using VUG, Vanguard Index Fund. And I was just surprised myself. But we've talked to so many people, Bill, that it took you about how long from the time you woke up?
It was till I felt competent. It took me a year or two till I really felt competent. But that was being a type A physician person that had to read a bunch of books in order to feel competent, just like med school.
That's what happened. So it took me about 2 years to really wake up and start doing something different. But from the time you woke up to the time you felt competent, reading those books or whatever, about how long did it take you to sort of reach that financial independence milestone?
Probably, if you think about it, it'd be about 6-7 years where we reached the milestone of maybe being 80% financially independent, but huge gains in a relatively short period of time. Incredible. I would have liked to think where I would have been if I'd have done it earlier, but those times,
we can't change that.
Bygones are bygones.
Bygones are bygones. But so you made it pretty quickly as well. I generally will say, based on the people that we've talked to and all the research that we've done, between 10 and 15 years. So you obviously did it a little bit sooner than that. And if you want to, look at the retirement, you reach financially independent typically before you decide you're going to retire. But those are just, some examples of how you can move a lot faster than you think you can once you get going.
Yeah. I mean, this is a good time to have a job, right? This is a good time.
I wish I was still putting money in the market.
Yeah. I mean, the retirees may have it a little harder in that regard, but hopefully they've planned for this because it's going to happen. These kinds of things are going to happen multiple times in your lifetime. I was a bit ignorant of the 2008, 2009 crisis because we were paycheck to paycheck. And so when you're not saving, you're not really paying attention. I didn't know what my net worth was. I wasn't really following it. So I didn't really know from a personal standpoint how bad it got. I saw how bad it got for folks around us in the financial community, but we were just scrambling anyway, so it didn't really matter. And maybe there are people out there that feel that way today. Yeah. But wake up, realize that this is part of the process. And as J.L. Collins says, this is part of the process. And if you haven't yet, listen to his meditation on a downward trending stock market. It's about a 9-minute thing. It'll walk you right through feeling calm again.
And that's probably one of our biggest resources to kind of get over the mental side of this scary time. We all feel frightened. We all feel worried, like we don't have a whole lot of control. His meditation thing that he did for downturns in the market is gold. So we'll definitely include that in the show notes. But I listen to it on these days, and that's is very and who doesn't love J.L. Collins' voice? So that's the plus. And we will have him on the show again. He's refreshing The Simple Path to Wealth. Did you know that?
That's right. He's coming on our show and we'll talk about that. What are the new, I think he even talks about Bitcoin in this new one. But that should probably be part of everybody's investor policy statement, is listening to his meditation first thing before you do anything. So, this week has been a little rocky. Next week might be rockier still. We'll still be here recording Catching Up to 5. We'll try and bring you sort of more actual contemporary podcast at times on Wednesdays when things like this do happen. It's a fun discussion. I want to close probably with reading a quote from Jesse Kramer, one of our prior guests, because he took a bunch of calls today as a financial advisor from his clients about, okay, I want to do this. And he's like, well, let's not do that. And let me tell you why. But what he wrote today in our community, I think, is appropriate. Just wrote these words to concerned investor this morning. We don't let fear, panic, or other negative emotions guide our investing decisions. We also don't let greed or exuberance guide our decisions. Good investing is inherently a non-emotional practice. It's not easy, though. If it was, everyone we know would already be doing it. Times like these, especially, are when our mettle is tested. This is when the millionaires are made, when you can stay the course here and keep dumping cash on the fire.
That's right. And some tangible things that we did, any cash that I had sitting in my investment accounts where I was attending to get it invested, I brought more shares of my go-to fund, which is a growth stock index fund. So I did that today. You've been doing some things with your portfolio. Tell us anything actionable that you've been doing. Just as an example, it doesn't mean everybody has to do it, but what have you been doing?
Well, there's tax loss harvesting, which is a complex phenomenon, but fundamentally, and my sister's going to do this for the first time next week. So shout out to my sister, Kathy.
You go, Kathy.
When you had losses, you can have the government share in those losses, because if you sell shares that have seen losses, you can take $3,000 of those losses against your ordinary income every year and reduce your taxes. You're basically pushing your tax burden down the road. You got to be a little careful, because you can't buy the same thing back again. Say, for example, you sell VTI or VTSAX. You can't buy that back on the same day, because you want to stay in the market and see where it goes if it goes on an upswing. So you can, for example, sell VTI and buy VOO or the S&P 500, because those are similar but not identical assets. And you have to watch out also for something called the wash sale rule. You can't have done this for 30 days prior or 31 days after. So when you do this, you want to try not to be buying into what you're going to be tax loss harvesting. Read the articles that we post in the show notes for more details on this, but those are the fundamentals of how it works. It's okay to take losses and reduce your cost basis and let those losses count against future capital gains or your ordinary income in the tax year to $3,000.
So, Bill, this would only be relevant to taxable brokerage accounts, right?
That's correct.
Okay, so it would not be a retirement account. It would not be an IRA, not a 401k. This is only brokerage accounts. So keep that in mind, that it only applies to that. And I will put some more information in the show notes, because if you're in that position where you have a larger brokerage account, this could be very valuable to you. So we'll definitely put that in there. Now, Bill, I'm super glad that you posted, the question about the stock market going down today. But here's exactly what you posted. So if you're not in our Facebook group, join the Facebook group. join in on part of the conversation. And if you're in the Facebook group, I have a feeling that this post will continue to get more and more comments, but your post, here's exactly what it said. How is everyone doing with this current market correction? Are we headed for a bear market? Please encourage each other to stay the course. Time to buy, not sell. Consider tax loss harvesting and rebalancing. And that was a mouthful, but all the comments would ask questions. What is rebalancing? What is tax loss harvesting? And we do this great exchange of knowledge. Every single question that someone had, someone else in the group was able to reply. A lot of the people that have been on our podcast, they are in that group. And a lot of other smart people are in that group. Now, let me throw out a couple of the other responses, which are kind of interesting. So this, this kind of represents all the things that we've been saying, but buying cheap, I like his saying, buying cheap and stacking deep. So one of our community members, I'm like, that is the best comment I saw today. And then another one of our community members says, just holding what we have and buying more while it's down. We saw this during COVID. It's not a loss until you sell. So we've got some really smart community members, Bill.
Absolutely. And what's neat to see is that a simple question like, how are you doing, turns into a stream of comments that is on. And that was just today. Yeah. So, and a lot of helpful information out there for folks that are like, okay, what do I do? What is this feature that I can do? What can I do? What shouldn't I do? And it's times like this of stress when you want a community to support you in staying the course and in making appropriate moves, if any, with your portfolio.
So true, so true. So we just thought it was worth having a conversation today after the week that we had. We're not geniuses over here. We're just everyday people like you. And it just helps to talk about it. It helps to maybe put a few data points together and to acknowledge how you feel and what's going on. We don't know what next week is going to look like. We don't know what the rest of the year is going to look like, but we know what history says. We have a lot of information and data points that we can reference. And people like J.L. Collins has a cool meditation recording that we all like to reference. But hopefully this conversation has been helpful to you. Come and join us in the Facebook group. We talk about this all the time, and especially when something like this is going on. So, Bill, this has been great. I'm glad you took your Friday evening to chat with me about this.
Yeah, I mean, it's fun. It's good to try and be contemporary, where we run 6 weeks in advance. We're going to try and use these Wednesdays to do something like this, where we have a little chit chat about whatever issue comes up. I would encourage people to voice their questions in the community. Send us an email at bill@catchinguptofy.com with your question. Send one to Jackie at catchinguptofy.com. Send us your questions. Record a speak pipe. We would love to give you a shout out on air.
Yeah, if you want to know how to leave a voicemail, we love to hear your voice. I always include that in the show notes. So leave us a voice message if you don't feel like writing, or if you want us to share it on the podcast, leave a voicemail. But we're all in this together. We love our community. We're late starters that were not being served. And so we cater to our late starters. Things look a little bit different, but we can do this. We can do this. Once you get going, you are going to be amazed at the progress that you make. I know through experience, Bill knows through experience, and from talking to a whole lot of other people, that time horizon, I believe, is much shorter than what we've been told. It's not 40 years anymore. It's probably 10 to 15 years from the time that you actually wake up that you can reach financial independence. And that is what our show is all about.
And this is just a part of it. Jackie, have you finished that glass of wine yet?
No, you know what? I'm a teetotaler, so I'm a really slow drinker.
I'm gonna have to go get a beer. We've all earned it this week, guys. We'll talk to you this Sunday on Catching Up to Fi.
If you are listening to this, you are working on building your wealth with regular investments into VTSAX or a similar total stock market index fund. Or perhaps you are retired and have a portfolio balanced between VTSAX and VBTLX, or a similar total bond market index fund to smooth the ride. Now, the stock market has taken a dip. Or perhaps it has dropped about 20% into what is called bear market territory. Or perhaps it has even crashed further. Or you are worried it will. For the purposes of our time together, let's assume it has. Relax. Focus on the sound of my voice. Breathe in and out. In and out. In this relaxed state, let's acknowledge what you might be feeling. Perhaps you are afraid. After all, you are hearing the voices of panic all around you. Perhaps your stomach is clenched and your nerves are beginning to fray. Now allow those fears and tensions to melt away as we focus on what we know as index investors. That is, the ride may be volatile, but the market always goes up over time. Turn off all the screens, put down all the newspapers. Tune out the voices of panic, especially those in your head. Step away from the noise, gather all those fears and tensions, and on your next exhale, breathe them out. Feel your stresses release and drift away. Take a deep breath, exhale, relax. Focus only on the sound of my voice. Everything is going to be all right. The talking heads are wrong, as they always are. The stock market is not going to end. The world is not going to end. Everything is going exactly as we expected. This is all a perfectly natural part of the process. Market drops, bear markets, crashes are all to be expected. They are a perfectly natural part of the process. We have been expecting this one. We know what to do. Nothing. We do nothing. We know deep in our minds, deep in our gut, this is natural, and it will naturally pass. When it does, the market will resume its relentless rise. We simply wait. We do nothing. These periodic, expected, natural drops are what we accept as part of our wealth-building journey. They are a part of the path. They are what lead to the long-term gains we seek. They are welcome. Everything is okay. Everything is as it should be. You are going to be fine. Your money is right where it should be. You are right where you should be. This too will pass. The market will rise again. The market will fall. Then the market will go up again. It is like breathing, in and out, up and down. This is natural. This is to be expected. With each breath, you grow stronger. With each market cycle, your wealth grows stronger. This is the way of things. In your mind's eye, zoom out now. Zoom out beyond this day, this week, this month, this year, beyond this decade. Zoom out until you can see the big picture. Envision the historical trend of the index. You can see it. It grows, and then it dips, but it always recovers to new heights. Over time, it climbs and climbs and climbs. You know this. You have seen this. You are on this trajectory. Your money is growing, and you don't have to change a thing. If you are working and building your wealth, keep adding to your investments as before. You are buying them now on sale. If you are living off your portfolio and now holding bonds, here is the opportunity you have been holding those bonds for. When you rebalance your portfolio, that money flowing from those bonds into stocks is buying those stocks on sale. You are unconcerned with this temporary dip in the price of your shares. You know you still have the same number of shares as before. You still own the same piece of all those productive companies in the index. You still have all those people in all those companies, from the factory floor to the CEO, working to make you richer. And now, with this wonderful market drop, you can buy still more of those shares on sale. Perhaps you even adjust your spending to free up more money to take advantage of this wonderful opportunity. Continue to buy as much VTSAX as you can, as often as you can, and hold on to it forever. You will be fine. Stay the course. You are doing just fine. The market is fine. This is all very normal. This is all entirely expected. All that panic is only for media ratings. It is not real. The end is not here. This is but a pause in the market's relentless rise. Nothing more. Stay the course. Keep calm. Keep it simple. Keep investing. Stay invested. Ignore the noise. Let it drift away on the breeze. Now, slowly open your eyes. Notice the world around you. Everyone who loved you before the market drop still loves you. The earth is still rotating on its axis, taking us from day to night and back again. Children still laugh and play. Puppies still wag their tails. The sun still shines. The world is still a beautiful place. And you are yet one step further in your journey to financial freedom. You have met this test, and you have won. Recommit to your plan and continue confidently on your simple path to wealth. And now, go do something wonderful in this wonderful world with all your wonderful freedom.